Hey everyone, Blink Charging reported fiscal 2023 first quarter earnings results. So in this video, I was going to review all of the important things in those financial figures and just kind of elaborate on what's going on with Blink Charging stock. So let's begin. Revenue increased by 121% to 21.7 million. However, the net loss also increased to 29.8 million, up from 15.1 million in the same quarter last year. The good news is that the net loss did not go up by as much as the revenue went up, demonstrating that Blink Charging is achieving some economies in scale. The company contracted, sold, or deployed 6,461 charging stations, bringing its total to 72,939. And this is only the beginning. We need, what, 10, 20, 40 times more charging stations between now and the year 2040 if we're going to transition our entire driving fleet from ICE engines to electric vehicles. There's going to be a need for a massive investment in charging stations. And so this is just the beginning here for Blink Charging. It's got a long runway for growth. The gross profit margin improved to 21%. This was up from 16.2% in the prior year. Again, demonstrating economies in scale. Management says that as it transitions to in-house manufacturing, the gross profit margin is expected to improve. This is a good decision, in my opinion, to go from third-party outsourced manufacturing to in-house when you have the situation that Blink Charging is facing, right? Blink Charging, and the situation is the almost, I don't want to say certain, but the very likely significant demand for charging stations for the next 2 decades. This is very likely going to be a market that's going to experience significant growth over the next 2 decades. So when you have that in front of you, you are less at risk of making a bad decision by moving manufacturing in-house. The big risk with bringing manufacturing in-house is when you have a decrease in demand, your costs are going to stay high while your sales fall. That's the main reason why you don't like to do in-house manufacturing, is because it increases the risks when sales fall, because you still have those fixed costs. But when you're doing third party, when sales fall, you just tell your contractors, okay, I need less units. And so you spend less on manufacturing, on inventory. And then when sales increase, you spend more on manufacturing. So you can balance it out. You can balance it out. The problem with that is that it costs more when you do third party manufacturing, because you're not able to achieve those economies in scale. When your costs are fixed and sales go up, you create that margin that creates the profit. But when your costs are not fixed and they're variable and your sales go up, your costs go up. And so it's harder to create that profit margin. So I think this is a good decision. And also for another reason I'm going to talk about here, which is that on March 16th, Blink secured a contract with the United States Postal Service to provide up to 41,500 EV charging stations. That's a huge deal. That's more than 50% of what the company has done in its existence. So it's a huge deal, and now that it has that secured, it makes even more sense to bring manufacturing in-house, because you know you've got this deal, you know you're going to need to produce this many, up to this many units, and so it makes even more sense to bring the manufacturing in-house, lower the cost, and create a bigger gross profit margin. So Blink has 103 million in cash as of March 31st. That's important because the company's going through cash right now in its growth stage. The cash flow from operations worsened to 24.2 million, down from 11.4 million. I will point out that this deal with the United States Postal Service is important for its ability to raise cash as well. For investors looking to lend money to Blink Charging, it's less risky now, and they should be more willing to lend money to Blink Charging because they know that Blink has that deal secured. So it's not like they're lending money to Blink and feeling like, oh, is this company going to be around for a while? Are they going to lose out to competition? We're worried about lending money to this company that's losing money on the bottom line. But now Blink has this contract in hand, and they can go to lenders and say, look, we have this deal secured. They're going to pay us. We're going to have this demand here, and it's going to take us, several quarters, several years to fulfill this demand. And we're in this industry that's growing, so you can feel comfortable lending money to us. So that's also going to be a huge positive for Blink Charging as it goes out to secure funding. It can do so more comfortably and at lower rates. And the positive results from this quarter gave management confidence to reiterate their target of reaching 105 million in revenue and a gross profit margin of at least 30% in 2023. So very solid results from Blink Charging in this quarter, and encouraging that they continue expecting their gross profit margin to increase. So that's all I've got for this video. I hope that sheds some light on what's going on with Blink Charging stock. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.